Hey guys, in this video we're going over buy now, pay later loans. What the heck are they? How do they work? Do you pay interest on them? Are there late fees? I went into a handful of hours deep dive analysis looking into what this industry even is, the top companies, which we'll go into. Ended up even comparing these to credit cards to see which might be better, and at the end, if you guys decide to care to know my opinion on these types of loans, and I will say my opinion has slightly shifted through all this analysis. So real quick example of what a buy now pay later loan is. Let's say you have a purchase amount of $100 and you don't want to pay that $100, or you don't have the $100. You could break it down into payments. So for example, you pay $25 now. So you don't need that 100, only 25 now. Then $25 in 2 weeks, $25 in the 2 weeks after that, and $25 in the 2 weeks after that. You still have to pay the full amount, obviously. However, you don't have to pay interest if you make those payments on time. So that's kind of how it works. So I'm going to be showing you guys a bunch of screenshots. So the first one we'll look at here is from the Federal Reserve Bank of Boston. So this is just looking at the buy now, pay later. That's what BNPL stands for, by the way. We'll see that a lot in this video. Awareness by year. So the dark blue line is heard of buy now, pay later. So you can see that has been increasing from 56 to 76%. Then the kind of lighter blue is offered, that type of loan, still increasing, and then used, this type of loan, in the last 30 days. And you can see it went from 6.6 up to 9%. So overall, this is increasing in popularity. So this is just starting out, and this is what the Federal Reserve of Boston, their key takeaways. So if we want to start with that, buy now, pay later offers consumers the flexibility of short-term credit that is interest-free if they repay the purchase amount on schedule. So buy now, pay later users tend to be financially fragile. They tend to have low credit scores, minimal liquid assets, high confidence, past bankruptcy filings, revolving debt on their credit cards. This is all from the Federal Reserve of Boston. I'm not saying this, but they did go into more demographics of how women, Black, Latino consumers are more likely than their counterparts to use these types of loans. And I thought this next chart was kind of an interesting breakdown of looking at FICO scores. So you could see people with lower FICOs are more intended to use these, past bankruptcies. Then it breaks it down into race, ethnicity, the income. You could see most of these people are under $75,000 that are using this, and gender, if you want to look at that difference. So that's just a quick overview, and I think it's too important, so now it's time to look at what's actually going on with these types of loans. Let's look at the big companies involved here. So these are the main ones. Buy now, pay later, broken down into the most popular. So we could see the most popular is PayPal at 68%. The next one at 25% is Afterpay. Then it's Affirm, almost 22%. Klarna is the next popular one of 21.5%, and you could see some others of Perpay, Zip, and Zezel. Or Cecil? So if you haven't seen any of these names, if you checked out online, whether it's with Amazon or Walmart or really anywhere, and you go to the payment part, a lot of the times you see it there, oh, Klarna or Afterpay. And we'll go into how it eventually works, but you can see all those different companies. And then I also found this other breakdown, which I thought was kind of interesting. These are just different categories that people tend to use the loans for. So general merchandise is definitely the most at 32%. Fashion and beauty at 16%, travel and ticketing at 16%, and then some other smaller amounts of electronics, home, equipment, and other stuff. I'll throw a couple more charts just to get you more familiar with what's going on and how popular it is, and then we'll go into actually what it is. But you can see that it is increasing in popularity over the past couple of years, and even comparing it to credit card balances. And that's what we're eventually going to kind of compare to toward the end of the video. But again, credit card balances are skyrocketing. You can compare it to the past several years. Also with the level of charge-offs, Obviously, you could see a huge spike in '08 when people were not able to pay their credit cards. Then during COVID, it did drop off because people got a lot of free money. But since then, it is going back up. And then real quick of looking at interest rates on credit cards, of how those are super high. And I wanted to bring this up because that could be why people are getting into these types of loans, because it could be a little bit easier or less interest rate. So I was doing a lot of research into Affirm because they are a public company, so I was diving into all of their documents and everything like that. I wanted to show you guys some stuff. So how Affirm, and if you remember that was one of the top companies people use, how Affirm helps customers. So they're saying Affirm empowers consumers by offering a transparent and flexible way to pay over time with no late or hidden fees. So they do help consumers pay at their own pace, whether it's bi-weekly or monthly, which we will get to. And Affirm doesn't charge any hidden fees nor late fees. And when I first saw that, I'm like, wait a minute. How are they making money? And that's why I wanted to really dive into it. Because you can't just use someone's service for free. Then the business won't survive. The interest-bearing transactions we facilitate only include simple interest. That means that the interest is based upon fixed percentage and it never compounds. So this next part of how Affirm helps merchants, this is kind of the other side of their business. If you're questioning, like I am, how are they making money? They charge the merchant a percentage. So real quick, for example, if you buy, I don't know, something from Apple, Expedia has to pay Affirm a small percentage. I saw it ranged from 2% all the way up to maybe 12%. This stood out to me, this next part. Affirm helps merchants of all sizes drive growth and better serve their customers. Overall, merchants using Affirm reported more than 60% higher average cart sizes in calendar years 22 and 21. We've proven that we could increase sales and introduce new consumers to our merchants partners. So did you catch that? They're increasing the amount of stuff that they're actually selling, which does make sense. If you have a purchase that was originally going to be $100 and you only have to put $25 down now, you have some extra money now. So then you could buy more. So I found a lot of this information from their earnings reports and stuff like that, because I really wanted to dive in. When they say no interest, I'm like, bells go off. It just doesn't make sense. But it's actually true. We'll get into it. And we already mentioned how they make money a little bit with the merchants. But over here, no ability to revolve by design, no gotchas, no late or hidden fees, no surprises. And with review, that's actually true. They do underwrite every individual transaction before making a real-time credit decision. So they do a soft pull on your credit to see how your financial situation is, to see if you could actually pay this back. So that kind of gives them a little bit more safety and less risk. They are pretty transparent, I will kind of say that. They provide a truth in lending disclosure before each transaction. Okay, so they'll tell you how much you'll end up paying, and pay in 4 interest-free payments. Monthly installments can be interest-free or simple interest-bearing. So, like we mentioned before with the 4 interest payments, if you go longer than those 4 payments, if you want to do monthly, they could go up to, I think it was 3 months, 6 months, or 1 year. At those points, that's when you start paying interest. And this goes into a little bit more detail. Affirm's monthly payment options can be interest-free or simple interest-bearing, generally ranging from 0 to 36%, consistent with the 36% rate cap that has been supported by consumer advocacy groups. Okay, so it does range. It probably depends on your credit or how likely you're going to pay it back. So we're starting to learn how the company works, how they're making money. So this should help you have a better idea of how it breaks down. I know there's also Klarna and then Afterpay. They might be slightly different, but this is just to give you one of the big companies, and since it's public, I was able to easily find it. Pay in 4. If it's between $50 to $1,000, you can see number of payments, obviously 4. You pay it every 2 weeks. Down payment may be required, and it is interest-free. So if you pay it on time, then yeah, it is technically no interest. And then the monthly installments from $50 all the way up to $5,000 may differ by store, but number of payments could go between 3, which would mean that it's 3 months, all the way up to 60. Now just to compare, this is Klarna. So make one interest-free payment every 2 weeks. So same idea, every 2 weeks, kind of like a paycheck if you get paid every 2 weeks. You split the cost, paying for, pay just 25% up front, and then, 25% to eventually pay it off. Again, no interest. So this is from Klarna. Charges no interest with pay in 4 and no fees unless you fail to make a payment. A late fee, so it seems like Klarna might be different. Affirm there are no late fees. You'll just be extending it further, like maybe into monthly, so you'll earn interest but no late fees. Klarna seems like there are late fees. Up to $7 may be charged if any scheduled payment remains unpaid after 10 days. The total of late fees charged on an order will never exceed 25% of the purchase. Alright, so you can't just keep racking up late fees. So this is from Affirm, and I love that they do this because it does make it super transparent to know exactly what you're paying. So let's say your purchase is $500. One payment every 2 weeks, so a total of 4 payments of $125 will cost you $500. So still the total amount, however, no interest. Then the next option, for example, is 6 months. There is an interest rate of 15%. So that is kind of high. I will say if you're comparing to a credit card, similar to in the beginning I showed you the rates, those rates are north of 20%. So this is a little bit less, but they do charge interest, kind of still high, but you would be paying 6 times of $87, and it'll cost you $522 and change. If you choose 12 months, again, 12 payments, the interest is still 15%. You're making $45 payments, and it will cost you $541.55. So that's where you start seeing interest included into the situation. So again, if you're paying every 2 weeks, there is no interest. You could pay it off, boom, you're good. This is just another example of using $1,000 if you want to look at that. So every 2 weeks, you'll be paying $250, again, no interest. 6 months with that 15% interest rate, you'll be paying an extra $44 in interest. And then if you're doing 12 months with that 15% interest, you're going to have to pay $83 in interest. So this is where I wanted to start comparing the buy now, pay later loans to credit cards, of how that interest might differ. So for example, I just used a credit card payoff calculator. You could find it on Google. So I used that $1,000 balance, like we kind of looked at from the buy now, pay later, just the slide before. I saw the average interest rate was around 24%, so that's why I put that. And I just put a monthly payment of $100. This would take you 12 months to pay off, and the interest would be $127. Comparing to the buy now, pay later, the interest was, if you're doing 12 months, $83. So with a credit card, obviously, a little bit more. The problem with credit cards is if you have smaller minimum payments, you get destroyed. And this is what I wanted to show here. So again, same $1,000, same 24% interest, but let's say you're only making $50 payments. It's going to take you 26 months, and the amount of interest you're paying is $289. And to make you throw up a little bit more, if you're making just the smallest amount of payment possible of $25, it's going to take you 82 months, and the amount of interest, you're literally paying more interest than what you actually bought of $1,000. So it does make sense if you're going to choose whether it's a credit card or a buy now, pay later. Buy now, pay later could be a better option. And if you're making those payments on time, there's no interest. And I'll start giving my opinions after doing all this types of research and understanding buy now, pay later loans now. I understand how people would want to get into it. When you're having that, there's no interest, you're able, and instead of having that huge payment up front, every 2 weeks you just pay it off, and then you're all good. So in that perspective, it could help you. In interest rate perspective, It is better than a credit card. It's 50, well, that's for a firm. Might be different from other companies, so double check which one you're using. But chances are it's going to be less interest than a credit card. It seems like every purchase they do a soft credit pull, which is different than a credit card, because once you have the credit card, you could just buy whatever. And they might not cover everything, maybe not everything that you're going to buy either on Amazon or whatever store you go to. A credit card you could use anywhere. Buy now, pay later might be a little bit more specific. So I believe if you have an unexpected large purchase for whatever reason of like $1,000 and you're like, I don't have $1,000, you could split it up, $250, $250, $250, $250. You have a job, you're going to be paid in 2 weeks. So I'm like, all right, that could make sense. So that's where my mindset kind of shifted. Originally, I'm like, oh, this is a scam. No interest? How is that even possible? I wanted to read the fine print. How do they make money? I don't like this. But that is actually true. Now, the problems that arise for me is, if you remember when we first started reading into a firm, they're able to increase the sales for the business. And it makes complete sense. So if all you have is $100 and you use a buy now, pay later and you only need $25, guess what? You still have $75. So then you go and spend that $75. But wait, you still owe that original $100. So instead of only paying that $100, you're now paying $175. So you could easily buy more because you're paying less monthly. So they're kind of messing around with people's psychology, thinking that you're able to afford more when, you kind of can't. If you're a person with a lot more money, you're probably not going to do this. You're just going to pay whatever it is and move on. My main issue, I really wanted to put this out there, is that the question shouldn't be what's better, buy now, pay later loans or credit cards. I feel like that's the wrong question. Now, there is an answer. It would be probably, depending on, the specifics of what you're doing, would be the buy now, pay later, probably. But the better question would be, should I go into debt or not go into debt? I feel like what these companies are doing is making people even more dependent on debt and borrowing money and always having a payment there. I feel like that's the biggest problem in this country, the amount of debt that we all have. If you're only going to be focusing on how much I could pay every month versus how much it actually is, people are struggling badly out there. And part of it is part of the reason would be because they're in debt. Whether it's student loan debt, whether it's credit card debt, whether it's mortgage debt, whether it's any other type of debt, personal debt, a car loan. It's all this debt, and what this does is just kind of expands that. Might be a little bit more flexible for you and kind of help you in the short term, definitely. Now, there might be people out there like, well, if I just paid off in that specific time and there's no interest, then what's the problem? Well, that goes back to what we mentioned before. If you're having smaller payments, then you might be inclined to buy more. And again, that psychology of just always having debt payments. It's not healthy. So have you guys ever used buy now, pay later loans? You could let me know. Will I ever use it? There's a 99.9% chance that I'm not going to use it. If I'm going to buy something, I'm going to pay it off. I do use credit cards, but I've paid off in full every single month. I'm the person that banks hate because they don't make money on me, and I do get the cash back. I understand a lot of people might not be able to do that. Some might also argue then you shouldn't be spending so much. Then you could also argue of inflation and everything is just costing so damn much today. Heck, even McDonald's is expensive. You can't even go off to fast food. So that's why I understand how some people could think this is a great thing and how others think it's not. But I don't think this isn't the answer to everyone's problems. I don't think it's that. It could help you a little bit. But if you're questioning to use this on every single purchase, then I think there's a problem. So let me know what you guys think, and if you are in debt like a lot of people are, I do have another video going into how to get out of debt fast. So hopefully you aren't drowning in debt, but unfortunately I think a lot of people are. But there is a way out. So hopefully this kind of helped you understand buy now, pay later loans. Any questions, comments, concerns, leave them down below. I'll try to help you out, and we'll see what the next video brings. Any topics of interest, you can let me know, and I'll see you then.